Welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have Euro USDs for our chart. All charts to be presented are to be of the same time frame. We will be mixing technicals with fundamentals today, once again. And okay, let's make a start with the fundamentals in both sides of Euro USD. Now, regarding the euro, we had the release of Germany's industrial output, which was better than expected. It accelerated, got out of the negatives, was well in the positives, more or less. That tended to, though, leave euro traders rather unimpressed. Similarly, also, we had the Sendex index for the Eurozone, which also was better than expected, despite being still in the negatives, and also tended to leave Europe traders rather impressed. On the other hand, on the USD side of the pair, and those fundamentals will be applying also to any other major pair which we will be presenting. Now, we had a better than expected, far better than expected US employment report for March. That was on Friday. It was characteristic that the NFP figure was expected to drop. It didn't. It actually rose. While the unemployment rate was expected to remain unchanged at 3.9%, it didn't. It ticked down to 3.8%. Overall, the tightness of the US employment market was underscored. And given the Fed's dual mandate to practically keep inflation low and steady at around 2%, and on the other hand, promote maximum employment, the tight, or if you rephrase that, the picture of a tight US employment market provides the Fed practically with leeway in keeping rates high and practically keeping a tight financial environment in the US economy. It's characteristic, I would say, that the market now, according to Fed funds futures, expects the bank to start cutting rates in the July meeting. Mind you that before the release, the market was expecting the bank to start cutting rates in June. That seems to be out of the picture for now. Market-wise, I would note that despite a hiccup, practically the US dollar lost any ground gained by the release. So the support the US dollar enjoyed was more temporary of nature and returned to the same levels. In my opinion, though, there is still some bullishness for the US dollar simmering under the surface in the FX market. And attention now turns practically to two releases. The first would be the release of the US CPI rates for March. A possible failure of the CPI rates to actually slow down further, implying an further easing of inflationary pressures in the US economy, could actually harden the Fed stance even more and provide some support for the USD. Mind you that the forecasts for the release currently are providing mixed signals, as the year-on-year rate at a core level is expected to slow down, but on a headline level, it's expected to accelerate. So that's going to be a little bit messy. The second issue I would be highlighting for the USD would be the release of the Fed's meeting minutes for the last meeting. And should the document actually show a hesitancy on behalf of Fed policymakers to actually start cutting rates, that could provide a boost for the USD. Now, returning to Euro USD's chart, and on a technical level, we note that there is a tight sideways motion, maybe some slight bearish tendencies during today's European session. And looking at the resistance support lines, the resistance levels are more or less there. You can see how the R1 is resting on this peak here, the R2 is resting on this peak, and the R3 on this peak. I know that the levels between the two are pretty tight. We're talking about 70 and even less 45 peeps here. So it's pretty narrow, and it reflects more or less, in my opinion, also the tightness of the movement. The support lines, on the other hand, despite the S1 being pretty valid, I would reconsider the level of the S2 and edge it higher to the nearest true. Practically, that would mean that it goes to the 1.0725. Sorry. Here you go. Let's have a look also at the S3, where it rests. Unlocking the chart, going back. And I'm raising it all the way up here. You can see how this level provides support a number of times. And that's the 1.0660. Let's have a look. Yep. This 4 comes out of the picture. Let's readjust the chart, widen it a little bit to have a better look at the price action. Always we are in the 4-hour chart, but I would like, sorry, to drill out of the 4-hour chart into the daily chart. I would like to have a look at the big picture here to see where this is heading to. It's already clear that the price action has breached the downward trend line, moving it, and has stabilized between the R1 and the S1. So the outlook for the sideways motion to continue seems to be present. Let's have a look at the daily chart though. Yep. It's interesting how the R1 and the S1 are being verified here as well. Yeah. Let's drill into the 1-hour chart. We have some slight bearish tendencies. Note how the pair has been dropping 1, 2, 3. This is the 4th hour, and more or less tends to imply a downward motion, but for the time being it's unconvincing. Back to the 4-hour chart, we're adjusting it. So for the time being, we tend to maintain a bias for the sideways motion to continue. And we're basing that practically on 2 issues. A, the sideways motion of the pair between the 1.0875 and the 1.0795. On the other hand, I would be also noting here that we have the RSI indicator, which is moving along the reading of 50, implying a rather indecisive market. That could allow the sideways motion to continue. The Bollinger Bands are narrowing, also implying some low volatility for the pair, also implying more or less that the sideways motion may continue. I would be noting though that the 20 moving average, which is the median of the Bollinger Band, so right here, is pointing upwards, but note how the price action has broken below it, and it's about to break also the 100 and the 200, and the 200 moving average. The 100, which is in orange, and the 50 moving average, which is in green. That may be implying some slight bearish tendencies here. Overall, though, for bearish outlook, I would require the pair to breach the 1.0795, and I'm saying this because I want to see a lower true than this one. And start aiming for the 1.0725, a level which provides support here beautifully. It was the level which reversed the downward motion of the pair over the practically 3 weeks from the 10th of March up until early April. For a bullish outlook, despite that being rather improbable, it's still a possibility. Should the bulls take over, I would require the pair to breach the R1 1.875 and start aiming for the R2 1.0935 before actually adopting a bullish outlook. And actually, such a scenario would allow us to draw an upward trend line showing us the limitations of an upward movement. Once again, base scenario for Euro USD is to remain in a sideways motion. I think we have a similar picture also for GBP USD. Yep, here it is. Okay, let's widen this a little bit. It's a very, very tight range-bound movement by cable. You can see similarly the RSI indicator running along the reading of 50, right here. The price action is already below the moving averages of the 200 and 100, and also the 20 moving average, which is the median of the Bollinger Bands. In my opinion, that moves sideways, maybe with some slight bearish tendencies as well. But for bearish outlook, I would require the pair to clearly break the S1 1.2590 and start aiming for the 1.2470. On the other hand, for bullish outlook, I would require the pair to breach the R1 1.2665 and start aiming for the R2 1.2775 right here. Let's have a look at USDJPY. This is an interesting development. You can see how USDJPY has been moving in a sideways motion, but an upward tendency over the past 24 hours has emerged. It's characteristic that the release of the US employment report for March had a very, very little, if any, effect on the pair. And the pair is constantly testing the R1 151.95, a level which was tested once, twice, 3, 4 times in the past, in the recent past, practically since the mid of March. Should the R1 be broken, clearly, and the pair starts aiming for the R2 153.80, then we may be talking about a renewed bullish outlook of the pair. Mind you that the RSI indicator has been rising above the reading of 50, implying a building up of a bullish sentiment among market participants for the pair. It's going to be a very, very interesting battle here. And on a fundamental level, JPY has its own fundamentals, given that we have a release tomorrow during the Asian session. But if I'm correct, BOJ Governor Weda is scheduled to talk on Wednesday morning. So that's going to be interesting as well. Should Mr. Weda actually show some hesitancy towards further normalization of the bank's rather loose monetary policy, that could weigh on JPY and actually push USD-JPY higher. On the other hand, I would be noting that the pair is near levels where the Japanese government may intervene to the yen's rescue, i.e. buying yens from the international markets and thus driving its price higher. So that would be a scenario that would cause USD-JPY to fall. USD-JPY, which by the way, let me drill into the weekly chart, is near 30-year highs, 34-year highs. And that may be providing some cold feet for the bulls to proceed higher. Now, that's one issue. On the other hand, though, for our sideways movement bias to be abandoned in favor of a bullish outlook, once again, we would require a clear break of the R1. For a bearish outlook, we would require the pair to drop, break the low boundary of the current sideways motion, i.e. the S150.80, and start aiming for the S249.20. Now the question arises, how could fundamentally USD/JPY being set under selling pressure? That could occur in two scenarios, or even a combination of the two. The first would be a weakening of the US dollar. Now, weakening of the USD would occur should Fed policymakers actually start hinting that they're quite certain about the number of rate cuts in the current year, possibly 3. In my opinion, that's still a bit remote. I think Fed policymakers will be wanting to see how the whole situation with inflation is playing out before actually committing to any rate cuts. The second scenario, which we have already mentioned, would be a possible market intervention by the Japanese government. I would be inserting here also a third reason, and that would be more or less that the JPY gains on safe haven inflows. We have a number of geopolitical issues and escalations, tensions in the relationships and the uncertainty of the market, which may drive traders fundamentally to the Japanese yen, given that the Japanese yen has a status also as a safe haven on international markets. Another issue which could actually provide some bearish tendencies for the US dollar side would be a deceleration beyond expectations of the CPI rates of the US for March on Wednesday, while also should the Fed's meeting minutes show a relative decisiveness on behalf of Fed policymakers to actually cut rates, that could also provide some bearish tendencies for USD/JPY. Okay, sorry. Let's have a look at USD CAD. So USD CAD has been moving also in sideways movement between the S1 1.3505 and the 1.3615. Some slight bullish tendencies seem to be present. And at this point, allow me to drill into the 1-hour chart. Okay, the 1-hour chart tells us that there were bullish tendencies. However, the pair stabilized somewhat around the or below the R1 1.3615. But the big picture, you can see how the pair is ascending higher, slowly but steadily. There are a number of higher troughs and higher peaks. So that may be implying some slight bullish tendencies. Also, the RSI indicator of the 1-day chart is above the reading of 50, implying a buildup of some bullish tendencies for the pair. A big event on a fundamental basis for cut traders this week is expected to be the release of BOC's interest rate decision. That's on Wednesday. The bank is expected for the time being widely to remain on hold. So that should be no issue. But it's going to be interesting to see what the outlook will be, or at least what the forward guidance will be of the bank on a monetary policy level. Should the bank turn even further away from the prospect of any rate hikes in the future, I would expect the Canadian dollar to lose some ground. And I'm basing that because when the minutes of BOC for its last meeting were released, it seemed as if BOC policymakers were abandoning the possibility of another rate hike in the future. So that was more or less a confirmation that the next move will be to the downside, most probably. And that's quite interesting. On the other hand, once again, we note more or less that we have some slight bullish tendencies, which may be implying a temporary strengthening of the USD. Anyways, for a bullish outlook, I would require a clear break of the R1 1.3615. And despite on Friday a slight break, a false break, I would be noting that the level, the R1, has provided repeatedly resistance once here, aimed for here, and tested here, and tested even today. So it seems rather important as a resistance line, and I would require a clear break above it before actually adopting any bullish outlook. Possibly for the pair to start aiming for the R2 1.3715, which would also allow us to start drawing an upward trend line. Back to the forward chart. Okay, let's have a look at AUD USD. This is the forward chart. Let's readjust, correct the positioning of the labels. And definitely we have to make a correction here. The S1 has to be turned into a resistance line, given that the price action has moved below it. Let's go hunting for a new ultimate support line. This is a nice show, pretty narrow, but still in green. $0.6440. Readjusting the chart. Let's correct the labels as well. But before we move on, I'm still in doubt about the S1. And actually, I'm going to be raising it all the way up here. 0.6550, that's my first support line. $64.80, my second support line. And $64.40, my third support line. I noticed the discrepancy, or at least if you mentioned otherwise, the difference between the margins between the resistance lines and the support lines. And we have as a final resistance line the 0.6665. This is it. Now, on a fundamental basis, already we have covered the US dollar. I would be concentrating also on AUD. We have two financial releases, which, okay, they're not of high impact usually, but macroeconomically, they're quite important. We're talking about the NMB business confidence and business conditions. Should there be an improvement in the indicators readings, we may see they're also getting some support here. Fundamentally, I would be highlighting the path of the Chinese economy and any improvement in the economic outlook of China could also be providing some support for the Aussie, given the close economic ties between Australia and China, and given that Australia is exporting a wide number of raw materials to China. Thus, I would be highlighting during the week the release of China's trade data, with Aussie traders probably being focused on the release of China's import growth rate. Definitely the trade balance is also very important, but the import growth rate for Aussie traders is more directly linked to Australia's economy as such. And should there be an acceleration of the import growth rate, a substantial one, we may see the Aussie getting some support and vice versa. On a deeper fundamental level, I would be highlighting that the Aussie as a commodity currency is very sensitive to market sentiment, given that it's considered to be a riskier asset in the FX market. So any improvement of the market sentiment may actually provide some support for AUD, and any more risk-averse stance on behalf of the market could weigh on the Aussie. And talking about AUD, we may see it also having some worries in the following sense. We expect that, or at least we know there's a possible tensions between the US and China to rise. And if that occurs, that should be within the next possibly 48 hours. Now, should the tensions rise between China and the US, especially about the Taiwan Straits, we may see the Aussie being set under pressure. Now, on a technical level, for a bullish outlook to emerge, we need higher chows and higher peaks. And despite we having here higher chows, we would require also higher peaks. So the pair has to rise, breach the R1 0.6595, which is the upper boundary of its current sideways motion. In my opinion, though, also breach above the R2 0.6625. We need a higher peak than this one. So the pair has to at least test it. In my opinion, it has to even breach it clearly. And that would allow us to draw a nice upward trend line, which could show us the limitations of a possible upward motion. On the other hand, we have to note that the pair seems to have peaked, corrected lower, and stabilized. Should we see a bearish outlook, we would require the pair to drop, breach the S1 0.6550, and start aiming for the S2 0.6480. I would also be noting, though, the RSI indicator, which has been on the rise. And mind you that AUD USD has been on the rise in today's late Asian and early European session, despite a slight strengthening of the US dollar. So the outlook here remains in a sideways motion bias, but the risk is tilted more to the upside in contrast, say, for example, with the euro or the pound, where the risk of euro USD and cable is more tilted to the downside. Let's have a look also on gold. Okay, gold has been in a mess. Let's readjust the charts. Sorry. This is always the 4-hour chart. We definitely need new record highs here. In red. Let's clear the chart, reposition the labels, correct them. The S3 is now being set at 2,228. The S2 at 2,268. The S1 at 2,302. Could go a little bit higher. 05. Yep. The R1 is being set at the peak here at 2,350. It's an all-time high. So we move based on the pair's volatility at around $50 per movement. So the R2 is being set at 2,400. And the R3 at 2,450. Okay, there's a clear-cut upward movement, supported also by an upward trend line. Sorry, we tend to maintain our bullish outlook for the pair. Sorry, for the precious metal, given that it maintains an upward movement which forms higher peaks and higher troughs. Once again, the highest level tested so far was the 2,350. Actually, there was a slight false break above it, yet quickly returned lower. Yet should the bullish outlook be maintained, we would expect the price action of gold to breach the 2,350 and start aiming for 2,400. Mind you, the RSI indicator is above the reading of 70, bit slightly above the reading of 70, which may on the one hand underscore the strong bullish sentiment of the market for the precious metal. On the other hand, though, may also be implying that gold's price may have reached overbought levels and may be ripe for correction lower. Similar signals, we're getting them also by the fact that the price action of gold is flirting with the upper Bollinger Band, which, okay, definitely on the one hand is pushing the margins of the Bollinger Bands to widen, but at the same time may be slowing down the bulls a bit. Once again, bullish outlook be maintained. For a reversal and bearish outlook, the bar is pretty high. we would require the precious metals price to drop, breach the 2305, breach the pre-mentioned upward trend line. That would be the signal that the upward movement has been interrupted, and start aiming, if not actually test, the 2268. So practically a lower trend on this one would be very helpful in establishing a bearish outlook. That would also allow us to draw a downward trend line, showing us exactly the limitations of that downward outlook. Okay, last but not least, I would like to have a look at WTI. We have a very, very interesting move here. But before we make any comments, let's reverse the role of the 85.40 from a resistance line to a support line, given that the price action has moved above it. Let's narrow also the peak. And at this point, I would be deleting that's more clear. Let's have a look at the resistance lines. Drilling to the daily chart, we have a beautiful peak here, which cannot be neglected. Note how this level provided a reversal of all of this upward motion into this downward motion. And we're talking about the daily chart here. So that would be the red $93.90. Let's also correct the labels. R2 being set at 90.35. The R1 at 87.10. The S1 at 84.10. The S2 at 82. And the S3 at 79.10. Now let's clear the chart from all the previous trend lines. And channels. I would like to see a clear chart which will show me the tendencies in the long term of the commodity's price, because the game seems to be becoming thicker. Now we have definitely an upward trend line guiding WTI's chart currently. And I'm skipping this part here despite the small breakout as temporary. If we drill into the 1 hour chart, let's have a look. The picture seems to change. as we have an intensification of the upward movement, but also a breach. It's going to be very interesting to see how the market will be reacting. In my opinion, the fact that the price action has hit, back to the forward chart, let's reposition the labels. In my opinion, the fact that the price action has hit the ceiling at the 87.10 resistance line, corrected lower, yet respected the 84.10. Note how this has provided also support here. That tends to imply a possible stabilization of the commodities price, given also that we have a breaking of the upward trend line guiding it. In the long term, though, the trend has not changed. So for the time being, we see the interruption of the upward movement as being temporary. It's characteristic how the RSI indicator has hit a floor at the reading of 50, not lower than that. And note how the price action, despite opening with a negative gap during today's Asian session, seems to be about to recover any lost ground. A positive confirmation of a continuance of the bullish outlook would be a breach of the 187.10 and the commodities price to start aiming for the 90.35. Should, on the other hand, WTI's price remain set in the boundaries between the R1 and the S1, then we may be talking about a bias for a sideways motion emerging here. That should sum it up. From all of us here at IronFX, best wishes for solid trading.
All right. Okay. Before we kick things off, let's quickly go through the risk warning and disclaimer as well. Do take note that all the products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. Right? In this webinar should be investment recommendation, but instead educational material only. All right, so my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, so today's webinar series will be the first part of the Fibonacci series. So we'll be looking at retracements. So we'll start off with the basics, of course. We'll look at how do we identify an ideal market structure? How is it different from something that's non-ideal? Why is that important? Because when we are trying to use the Fibonacci retracement tool, we should be looking for ideal market structure or something that resembles as closely as possible to an ideal market, right? Being the real life world, nothing's ever ideal when it comes to market structure or price action, but we are going to look for something that's going to be as close as possible to the ideal structure. Then we will look at how we can follow the market structure so as to achieve good or to achieve significant Fibonacci retracement levels, right? When we do not use the Fibonacci retracement tool correctly, and when we do not follow the market structure as closely as possible, then the retracement levels that are highlighted by the Fibonacci retracement tool will not indicate significant resistance or support levels, right? So that's the basics. We are going to identify what is an ideal market structure, what type of price structure in reality mimics the ideal market structure, and then how to follow that, and how do we draw the Fibonacci retracement from the starting point to the end point. Then we'll also look at the various Fibonacci retracement levels. Then we'll also touch on the negative Fibonacci levels as well as the levels that are greater than 100%. All right, so if you have any questions along the way, do not hesitate to drop your questions in the Q&A box or the chat box. I'll be more than happy to go through your questions should there be any doubts along the way. All right, so let's start off with the ideal market structure. What is an ideal market structure? Well, first of all, we'll start off by looking at what is wrong, right? Okay, so when we are trying to draw a Fibonacci retracement, we're looking for significant swings, right? So we're looking for market swings, so like a swing high or a swing low, right? In this example here, what we are seeing, this GIF is showing us an example of insignificant swings, right? So you can see here, I'll just label it, this is number 1, this is number 2, right? So swings like these are pretty insignificant, right? And also here, looking at here, 3, this is a swing high, 4 and 5, right? When you look at 1, 2, or even this one here, let's label this 6. You can see this swings, all these swing highs here, these are the highs, they're all pretty insignificant. So we're not looking for these sort of insignificant swing highs, right? Similarly, when we look for the swing lows, you look here, A, B, C, D, right? These are insignificant swing lows, right? So we're not looking for this type of market structure where the swing highs and swing lows are insignificant. This is pretty noisy, right? To a certain extent. So what we're looking for in a market structure that will have significant swings. Now, this can be swing highs and swing lows, of course, right? So now that we've had an example of what is or what are insignificant swings, let's move on and try and see how do significant swings actually look like, right? Okay, now here we have a GIF showing us examples of how to identify significant swing highs and significant swing lows, right? As you can see here, we need to look for significant swing highs and lows. So clearly we can see here, point number 1 is a significant swing high. Point number 2 here is a significant swing low. Point 3 is another significant swing high. Point 4 is another significant swing low. Point 5 is a high. 6 is a low. 7 is another high, right? So this GIF is clearly illustrating how do we identify significant swing highs and lows in market structure, right? So you can clearly see this is a swing high here, 0.1. This is a low, high. Number 4 is a low, 5 is a high again. 6 is another low, and 7 is a high, right? So do take note. This is how, this is a type of market structure that we're typically looking for when we're trying to identify swing highs and swing lows, because that's very important. That's basically the main foundation of Fibonacci retracements. We need to identify the significant swing highs and swing lows so that when we actually use the retracement tool and we draw the Fibonacci retracements, we are going to get retracement levels that would actually function as, or that would potentially function as very significant resistance or support levels, right? So what we're trying to do is increase the probability of these retracement levels functioning as a significant support or resistance, right? If you don't draw the Fibonacci retracement in the correct manner, the subsequent retracement levels are very likely not to yield any significance, right? Be it as a support or resistance, okay? Right. Now, how do we follow the market structure, right? Now that we've identified significant swings, highs and lows, now how do we identify, how do we follow the market structure when we use the Fibonacci retracement tool? So as we can see in this GIF here, point 1 is clearly a significant swing low. That's fine. That's great. Point 2 is also a significant swing high. Point 3 is another significant swing low. And point 4 is another significant swing high. But in this example, they're drawing the Fibonacci retracement starting from point 1, but going all the way up to point 4. As you can see here, the highlighted diagonal line, right? You can see the highlighted diagonal line is going to come up again. Now that highlighted diagonal line in blue, that is the trend line of the Fibonacci retracement tool, right? Fibonacci retracement tool. So when we start Fibonacci retracement, we always start from the left to the right. So when we're doing it for the upward part of the move, we're always going from bottom left to top right. Similarly, when we draw the Fibonacci retracement for the downward move, we're going to go from top left to bottom right. So do take note, this is another key aspect of how to use the Fibonacci retracement tool. We always go from left to right. So if it's an uptrend, if market structure is going up, right, we always go from point 1 on the bottom left to point 2 on the top right. Similarly, when we have a market structure that's showing a strong downturn, we're going to go from point 3 to point 4. That means we're going to go from top left to bottom right. Remember, Fibonacci is always left to right. Yeah. Whenever we are drawing the Fibonacci retracement tool, be it for the upward move or the downward move, we always go from left to right. So for the upward move, for the uptrend, we're going to go from bottom left to top right. And for the downtrend, we're going to go from top left to bottom right. Okay, that's another key aspect of using the Fibonacci retracement tool. All right, now going back to that trend line, remember I was talking about that can you see here, this highlighted in blue, this trend line. Now in this example, they've started this Fibonacci retracement starting from point 1 and ending it at point 4. We can clearly see that the trend line is not capturing the market structure at all, right? We can see that there's plenty of gaps to the top of the trend line as well as to the bottom of the trend line. So in this type of market structure, the ideal Fibonacci retracement, right, to be drawn would be from point 1 to point 2. So when we draw it from point 1 to point 2, we can see that the trend line will capture the market structure much better than from point 1 to point 4. Similarly, when we're doing it for the downtrend, we'll start from point 2 to point 3. And when we do that, the trend line will capture the market structure very closely. So that's what we're looking for. We're looking for the trend line to capture the market structure as closely as possible, be it to the upside or to the downside. So that's how we know whether we've drawn the Fibonacci retracement using the correct starting and ending points. Do take note, if the trend line does not capture the market structure very well, that means it's quite likely we have not used the ideal starting and end points for the Fibonacci retracement, right? Okay, let's go on to the next slide. Now here, we can see we've identified point 1 and point 2. Point 1 is the starting point. Point 2 is ending point. And you can clearly see that the blue trend line has captured the market structure as closely as possible. Of course, there are going to be a little bit of gaps to the downside and to the up of the trend line, but in general, we can see that this trend line has captured the market structure very well. Now, similarly, if we had drawn the Fibonacci retracement from point 0 to point 1 here, right, we would have seen that the trend line would have captured this market structure very well as well, right? Would have captured this market structure pretty well, right? So this is what we are trying to emphasize and highlight. So be it for an uptrend or a downtrend, Fibonacci retracements, we always go from left to right. For the uptrend, so bottom left to top right. And for the downtrend, we start the retracement from the top left, and we end at the bottom right. right? And the other aspect to take note of, or the important point to take note of, is the trend line must capture the market structure as closely as possible, be it to the downside or to the upside. All right. All right, great. Okay, let's move on to the next slide. All right, so now that we've had a quick look of how to identify ideal market structure, how to identify significant swing highs and swing lows, and also we've also seen how to draw the Fibonacci retracement in a manner that is going to give us significant retracement levels, right? We have to identify significant swing lows here. You can see 0.0 is a significant swing low, 0.1 is a significant swing high, and 0.2 is another significant swing low. And similarly, when we choose the most ideal starting and end points, the blue trend line is very likely going to capture the market structure very closely, right? So do take note of that. All right, okay, with that, now we're going to look at the various Fibonacci retracement levels. Okay, for those of you who may be aware or have used the Fibonacci retracement tool before, so we know that this goes from 0 to 100, right? 0 to 100%. Right, so the retracement levels as highlighted here, as you can see, or well, not highlighted, but as described in this image, you can see that the retracement levels run from 0% to 100%, right? So the key retracement levels are at 23%, 38.2%, 50%, the golden ratio of 61.8%, and the 78.6%. So there's 1, 2, 3, 4, 5 key retracement levels, right? So when we talk about the Fibonacci retracement levels, we're talking about the 5 key retracement levels running from 0 to 100, and they are, right, 23%, 23.6% to be precise, right? 38.2%, 50%, 61.8, which is the golden ratio, of course, and we end up with 78.6%, right? So do take note, these are the 5 key retracement levels: 1, 2, 3, 4, 5. 23.6%, 38.2%, 50%, the golden ratio 61.8%, and of course the 78.6%. Now, in this example, we have started this retracement from 0.1, the starting point 0.1, right? And the ending point 0.2. So do take note, Fibonacci retrace, the starting point of the Fibonacci retracement will always indicate 100%, and the ending point will indicate 0%. So conversely, if I were to draw the Fibonacci retracement from this part here, let's just identify this swing low as 0.4. Now, let me just tidy this up a little bit. Right, let's just identify this swing low as 0.3 and this swing high as 0.4. So when I draw the Fibonacci retracement starting from 0.3 to 0.4, my starting point is going to show me 100%, and the ending point is going to show me 0%, right? Just like how we see here on this downtrend, right? On the downtrend, we start from top left and we end at bottom right. Conversely, for the uptrend, we start at bottom left and we end at the top right. So starting point is always 100% and ending point is 0%, right? And the key retracement levels, like I said, are the 5 key retracement levels at 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Now, in this example, we're also showing Fibonacci levels that are greater than 100% and lower than 0%, right? So the negative retracement levels are the key retracement levels at the negative point are negative 27.2 and negative 61.8%. We'll touch on this a little later. Similarly, extension levels that are greater, Fibonacci levels that are greater than 100%, the key levels are at 127.2% as seen here, and what is not seen is at 161.8. But for now, let's just focus on the retracements, right? So 23 to 78.6, right? So as I mentioned, we started at 0.1. We started this retracement, right? We started this retracement at 0.1. 100%, and we end at 0.2, which is 0%, right? So we can only start this once the price has formed a swing low. So basically, we're waiting for price to make this significant swing low here, come up here, maybe the first after the first 1 or 2 candles or 3 candles, depending on your time frame. Let's just assume we are on the 4-hour time frame and we see 2-3 candles, at least 1 or 2 candles being formed after we see the significant swing low. That's when we can draw the retracement. So in this case, we're drawing the retracement from 0.1 to 0.2, and what the subsequent retracement levels at 23, 38, 50, 61, and 78.6, what these levels are going to highlight. These levels are what these levels are going to highlight are potential resistance levels. Do take note, when we draw the Fibonacci retracement for a downtrend like this, the subsequent retracement levels are going to help us identify potential resistance levels. All right. Conversely, when we draw the Fibonacci retracement for the uptrend, right, we're going to start from 100% and at 0. What the subsequent retracement levels tells us is going to highlight to us is our potential support levels, right? So we get 23.6%, 38.2%, 50%. So for the uptrend, the retracement levels are going to highlight potential support levels, and for the downtrend, the retracement levels are going to highlight potential resistance levels. Okay, right. So as you can see here in this example, 23.6% didn't offer much resistance, right? You could see price just stalling briefly here before going higher, where it does seem to have run into resistance. Okay, then after that 38.2%, we can clearly see price breaking above 38.2% as well. Where price failed to break above is at the 50% retracement, right? Clearly, we can see here price has failed to break above the 50% retracement. So this is a major resistance for price for this current example. So we can see just because we have a retracement level at 23.6% and 38.2% does not mean that price is going to stall at this level and reverse and drop lower, right? They are just points that are going to help us identify potential, right? What is important here, they are highlighting potential resistance levels. It doesn't mean that they will act as significant resistance levels, but what the retracement levels here are going to highlight is they are highlighting potential resistance levels. So, but in this example, you can clearly see 23.6% and 38.2% did not offer any major significant resistance. Where price did stall was under the 50%. So now we know for that 50% is a significant resistance level, and it's going to take something pretty like a strong catalyst for price to break above this level. All right, so do take note. The retracement levels highlight potential support or resistance. They do not indicate or they do not guarantee that these retracement levels are going to function as very significant support or resistances, right? Do take note. That's a very important, another important aspect of using the Fibonacci retracement tool. All right, okay. Moving on. All right. As I mentioned, the key retracement levels are 23, 38, 50, 61, and 78. Levels that are lower than 0. We also have Fibonacci levels that are lower than 0%. And we have Fibonacci levels that are higher than 100%. So we're going to get to those as well. All right, so the negative Fibonacci levels, right? So the negative Fibonacci levels are also known as expansion levels. You can see the key negative Fibonacci levels are negative 27% and negative 61.8%, right? These negative levels are also known as expansion levels, all right? So you may hear or come across this term, so do not be confused if you come across the term Fibonacci expansion or expansion levels, right? They simply refer to the negative retracement of negative levels, which are at negative 27.2 and negative 61.8. All right. Okay. So these are the key retracement levels for the negative at the negative end, and they are also known as expansion levels. Now, how can we use this? Okay. How can we use these expansion levels? Well, first, right, you can see we started this retracement from 0.1 here. and we ended at 0.2, right? And we can also see 50% is here. So in order to use the negative levels, or not rather to use, but for the negative levels to provide or to function as significant support levels, we actually need to see price retrace up to at least 50 to 61.8%, right? Do take note, price must retrace, right, after forming this low here, this significant swing low here. Price must retrace to at least 50% or even better 61.8%, so that when we see a market structure like this, and then should price reverse and drop lower, breaking under the 0% or the ending point, that means that these negative levels are expansion levels at negative 27.2 and negative 61.8% Fibonacci are going to potentially function as significant support levels, right? So do take note, this is another key aspect when using the expansion levels. The Fibonacci, the market structure must retrace up to 50 to 61.8%. It must, right? So at least 50%, and then should price reverse and drop lower, breaking under the ending point, that means negative 27.2 and negative 61.8 are going to potentially function as significant support levels, okay? This is a very important aspect, because if price only retraces up to 38.2% and then stalls and reverses to drop lower, that means this levels here at negative 27, negative 61 may not offer significant support, right? Do take note. This is one key criteria, right? The key criteria is the retracement has to come up to at least 50%, right? The retracement has to come up to at least 50%. I'm talking about this retracement here, right? It has to retrace up to at least 50%, even better if it comes all the way up to 61.8. And then as it reverses to drop lower, the expansion levels are then likely to function as significant support. All right. Okay. Now, in this example, we can see clearly that price has retraced to 50 and has even reached 61.8%, right? And then has now started to reverse and drop lower. Now, so how can we use these expansion levels? First off, as price starts to retrace to drop lower, we can also use the 0%, for example, as a potential take profit level, right? So if you go short on this position here and price is reversing, right? Perhaps there's a strong bearish catalyst that has a combination of a strong bearish catalyst, and your technical analysis is telling you this is now a potential short entry, where you would identify your take profit would be potentially here at the major swing low here at 0%. And should price continue to break lower, you can identify your second TP or take profit at the negative 27.2%. So, right, this is where we can this is how we can use the negative Fibonacci levels or the expansion levels to help us identify potential take profit levels for the short side, right? So in this example, you're seeing it for the short side, for a potential short trade, right? So typically, in this scenario, price will, if price breaks below this swing low here, it will typically find support at negative 27.2%. And usually it does bounce off this level to return to 0%. So do take note. So this is how we can use the negative 27.2% Fibonacci expansion level to help us identify a potential take profit on the short side, or for the potential short trade, right? Okay. With that, okay, now we're going to look at Fibonacci levels that are greater than 100%, right? The key Fibonacci levels that are greater than that are greater than 100%, as I mentioned earlier, at 161.8 and also at 127.2%, right? These are the two key significant retracement levels. Levels that are greater than 100, and these levels that are greater than 100, they're also known as Fibonacci extensions. All right, do take note. Right, so if you come across the term Fibonacci extension levels, it is simply referring to levels that are greater than 100%, and they're specifically referring to 127.2% and 161.8%, right? just like for the Fibonacci expansion levels. So similarly, if you come across the term Fibonacci expansion levels, they're referring to levels that are the negative levels, and specifically referring to negative 37.2 and negative 61.8. Okay, so expansion levels are negative, also known as the negative Fibonacci levels, also known as Fibonacci expansion levels, and the Fibonacci levels that are greater than 100% are also known as the extension levels. And the key extension levels come in at 127.2 and 161.8%. All right, so in this example here, right, we see price from this starting point here, point 1 making the swing high here, and then point 2 has made the swing low here. So how we can use the extension levels is we can use these extension levels to help us identify the take profit, a potential take profit zones. Sorry. So in this case, you can see price has made this Nike tick structure. You can see this Nike tick structure, right? We all know the company Nike and its logo, which is the tick. And you can also clearly see a price. This market structure here is following this Nike tick structure. So what we see is how we can use the extension levels is when we see price reverse strongly and come back up to the starting point, which is at 100%. Here we can say we're looking for potential bullish breakout here, right? We have our technical indicators telling us that this is a strong bullish move. We also have a strong fundamental data catalyst that's driving this move as well. So we are looking for potential bullish breakout. So when price breaks above 100% here, how we can use the extension levels is we can use them to identify potential take profit. So for example, 161 here has been identified here, and 127 is probably somewhere around here. So we can use these extension levels to identify potential take profit. So this could be the second take profit zone, whereas the 137.2% would be the first take profit zone, right? So this is how we can use the extension levels to help us identify potential take profit zones should price break above the 100% or the starting point and continue to drive higher. And then from here is where you could potentially is to identify a major resistance level. And from here, you could also potentially initiate a short trade idea as well. Because when you see price failing to break above the 161.8% extension level, it is quite likely it is going to drop lower. So as price moves away from this extension level and starts to drop lower, you can initiate a short entry, and your stop loss will be placed slightly above the 161.8% Fibonacci retracement to give us a little bit of a buffer, right? To give us a little buffer. So should price retrace back to the 161% as you can see here, but because we've kept our stop loss slightly above the extension level at 161%, it allows us to remain in the trade, and should price continue to drop lower, we can benefit from this potential short trade idea as well. So you can see how the extension levels can be used to identify potential take profit zones to the upside. And then once it hits 161.8% Fibonacci retracement extension, and then it starts to pull away, you can also consider initiating a short trade idea where you put the stop loss slightly above the 161.8% Fibonacci extension. All right. Okay, great. Let's see. Right, okay. We've come to the end in terms of my slides. So what are we going to do? What we are going to do now is we are going to move over to TradingView and try and find examples of how to use the Fibonacci retracement tool correctly, right? So we're going to start, of course, just start off with the basics. All right. Okay. So here I am on TradingView. I'm on the 4-hour time frame, and I'm going to use the dollar index as an example. Right. So first of all, we're going to try and identify significant swing highs and swing lows. So let's just do this exercise together, right? So just to take note, when we are using Fibonacci retracement tools, they generally work better on the higher time frames, right? So they generally work better on the 1-hour time frame and above, right? You can use them on the lower time frames as well, 30 minutes, 15 minutes, but they may not offer the same level of support or resistances as when we use them on the higher time frames. So do take note about this aspect of using Fibonacci retracements, right? They do tend to work better on higher time frames such as 1 hour and above. All right. Okay, so first of all, we do a simple exercise on trying to identify significant things, right? As we saw in the slides earlier, right? We saw examples of insignificant swings, and now we're going to look at examples of significant swings. So this is I'm on a 4-hour time frame for the dollar index, DXY. My chart is showing the price structure from end of September all the way to present time. So I think it's quite clear by now where the significant swing lows and swing highs, right? So, right, you can see here this is a significant swing low here. Okay, maybe hang on. Right, let's start off with swing highs. We can see this is a significant swing high. This is also another significant swing high here. This is another significant swing high. This is another high. This as well. This as well here, right? So 1, 2, 3, 4, 5, 6, right? These are generally how we would identify significant swing highs, as this one here as well. So the red circles are, I'm highlighting the significant swing highs in red. And now I'm going to highlight the significant swing lows in green. So you can see here, this is a significant swing low. This is another swing low here as well. Here, 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 and of course here, right? So what we're actually trying to look for, right, is I'm going to now just use a different color. So we're going to look for significant swings, right? So you can see when price makes a very strong V-shaped move here like this, as highlighted in the orange line, right? We can see that this is a very significant V-shaped move, right? And this tells us this is a significant swing low, and this is a significant move. Similarly, right, when I draw the swing high from here, we can see this is an inverted V shape, right? We can see a very clear significant swing high with a strong inverted V shape as well. Similarly, for this downside, we see a strong V shape here. And then for this swing high here, we can see generally the pattern I'm trying to get at. You can see that this is another inverted V. Similarly here, this is a strong V shape pattern here, swing, another strong inverted V shape here, another strong inverted V shape here, strong V-shape pattern here to signify the significant swing low. Another one here, inverted V-shape to indicate the swing high. Another strong V-shape pattern here to indicate the swing low. And this high here, low here, high here as well. This is also a pretty significant swing low bounce here. And of course, this significant swing low over here. Right, so you can clearly see how we can identify major swing highs and swing lows, right? That's important, right? So as you can see here, I'm just going to leave this on for a bit before I erase it. So you can clearly see the green circles highlighting the significant swing lows, whereas the red circles are highlighting the significant swing highs. And you can see by my orange V shapes as well. We see an inverted V shape as well as the regular V shape that show us the size of the move, right? We're looking for significant swings and lows and highs, and the size of the move can be is highlighted by my orange brushes, right? You can see that the moves are very significant. So this is how we identify swing highs and swing lows, so that we are able to identify ideal starting and ending points for the Fibonacci retracement, right? Okay, so now I'm going to clear all of this, and I'm going to show you how we can draw the Fibonacci retracement for these swing highs and swing lows. All right, so we'll start with here on 29th of September and we'll end here on 3rd of October. Okay, so for those who may not be familiar with the Fibonacci retracement tool, the icon looks something like this, right? So you'll see 4 lines and you'll have the bubble here as well, the circle here on the left and on the right. So if you highlight it, it'll show you depending on whatever platform you're using, but if you're using a trading view, right? If you highlight over this icon here, it'll tell you Fibonacci retracement. So that's what you want to use. So we click on that, and we're going to start with the absolute low point here. Okay. So I'm just going to zoom in a little bit. Right. So I'm going to just zoom in a little bit. This is my starting point, right? So remember, for this is an uptrend. So Fibonacci retracement always goes from left to right. Since this is an uptrend, we're going to start from the bottom left and we'll end at the top right. Okay, I'm going to pull up all the Fibonacci levels here. So this gives me the negative levels, the positive levels. Remember, negative levels are called expansion levels, and levels greater than 100 are called extension levels. Okay, right. Okay, but with that, I'm just going to focus on the retracement levels in this example, right? So as not to overcomplicate things. So I'm going to get rid of the extension levels as well as the expansion levels, right? And we're just going to deal with the retracement levels going from 0 to 100%, right? So then this is much more clear. So when we draw the Fibonacci retracement from this uptrend here, bottom left to top right, and as price is coming down, these retracement levels are going to potentially are going to highlight potential support levels, right? Now, whether these levels truly function as significant support levels, we can only tell when the move plays out. But generally, it does help us to identify potential support areas. So as price has made this swing high here and started to come down, we can see that price did find decent support at a 23.6%, retracing higher before falling lower. Then again, you can see here, it did find a little briefly found support here at 38.2%, again at 50, then also pretty strong support here, 61.8%, 78, and then finally 100 down here, right? So you can see clearly in this example here, price did seem to find support at almost nearly every single retracement level. Now, this doesn't always happen to be the case, right? There, as we saw in the slides, right, there can be cases where price will just simply break through the 23, 38, maybe even the 50, and then find support at the 61.8%. So do take note, in this example here, we do see price to have clearly found support at each of the retracement levels, right? Okay, this was an example for the uptrend. Now I'm going to draw a Fibonacci retracement for the downtrend, right? So this was the uptrend, bottom left to top right. We can clearly see here, this is a strong move down. We have a nice significant swing high here on 3rd of October, and we have a significant swing low here on the 12th of October, right? So we're going to start this retracement from here. Remember, whether it's an uptrend or downtrend, we always go from left to right. So since this is a downtrend, we'll start from, hang on. We'll start from the top left and we'll end down here on the bottom right. So in this example, we can clearly see price has broken through 23, 38, and 50% very easily, right? Very easily. These retracement levels here did not offer a hint of resistance at all. Where it did finally run into resistance was at 61.8%, right? And then after that, over the next half a day or so, price briefly broke above the 61.8 as well before dropping lower. So you can see where price found major resistance in this example is at the 61.8%. Do remember over here when we did the Fibonacci retracement on this uptrend here, we could see price finding support at every single retracement level. However, for this part of the move, we can see where the only level that offered serious resistance was at the 61.8% Fibonacci, right? So you can clearly see no two Fibonacci retracement is going to behave the same way, right? We are never going to see the same retracement levels functioning as a major support or resistance, right? Every swing high and swing low, every uptrend and downtrend is going to be different, right? So do take note of that. There's nothing set in stone with regards to the Fibonacci retracement levels. It could be a case where the retracement levels offer support or resistance at every single level, or there could be a case like what we're currently seeing, where only the 61.8% has offered significant resistance. All right. Okay. So here we can see price running into resistance at 61.8 on 12th of October, 13th of October as well as 19th of October, right? Okay, so these were the two examples of how we can use how we can draw the Fibonacci retracement for an uptrend and downtrend. All right. Okay. Now let's move over to somewhere to where price is currently trading. Right. Let's see where price is currently trading and perform some technical analysis here using the Fibonacci retracements. All right. Okay. So once again, before we try and draw the retracements, let's do a simple exercise where we can try and identify the significant swings, right? Okay, so this is a green. All right. So we can see here, this is a pretty significant swing low here on 29th of November. Another significant swing low here on 15th of December. This significant swing low here on 28th of December. So when we look at end November till now, we can see 3 significant swing lows when we're on the 4-hour time frame. All right. Okay, now I'm going to try and identify significant swing highs. Right. You can see here, this portion here is a pretty significant swing high here. And over here, okay, price has not yet played out, but you can generally see the top of this wick is another significant swing high as well. Right. Okay, so let's just say, okay, let me just okay, I'm just gonna highlight my points so it's easy to refer to as well. All right, so let's work with points 1, 2, and 3 first. All right, let's work with the first 3 points. All right, so we have identified our major swing highs and swing lows. But let's just focus on the first 3 points. So for this upward trend here, we would be actually technically we would have highlighted this as 0.2 because as price was pulling down, we have highlighted this as 0.2. So we'll take this in step by step. So we'll start the retracement for this uptrend here from 0.1 to 0.2, right? You can see here in this example, as price was pulling back, 23.6% did not offer any support at all. 38.2 not really, because we can see the wick extending way beyond the 38.2 and even dipping below the 50%. So where it did find support here in this example was around the 50% Fibonacci retracement, right? As we can see here, the body of the candles actually closing underneath the 38.2%. And we can also clearly see the wick extending beyond the 50. So where price did find support in this example was at 50% before going higher. And as price comes up here, right, when a new high is made, we cannot use 0.2, the original 0.2 anymore. If we do wish to use the Fibonacci retracement, we have to move our ending point now because this is a new high. We have to move it to here, which is, yeah. And in this sense, you can see the trend line, right, is capturing the market structure quite well, right? It's not in what is not as ideal, as perfect as what we saw here at the first go. You can clearly see the trend line has captured the market structure very well. But even when it makes this second high here, you can see that the trend line has captured the market structure quite well. So we can still use this. So similarly here, 23.6% did not offer any support. Where it did find support was this time round at around the 38.2 before retracing higher and then finally smashing through all the other levels. You can clearly see here as it smashed through 38.2, 50%, 61% offered no support. Where it did find support briefly was at around the 78.6% Fibonacci retracement. All right, you can clearly see how the retracement levels help us to identify potential, right? The key word here is potential support levels or potential resistance levels, right? Nothing is set in stone. It doesn't mean price has to react off each level, but it's just helping us to identify potential support or resistance levels. Okay. Now, after price has come down here, it has found support around 100 and 190 before proceeding higher. So now we have 0.2 and 0.3. We can also run a Fibonacci retracement on this downturn. So we'll start from here, 0.2, 11th of December, going down to 0.3, which is the 14th of December. So in this case here, we can see as price was retracing higher,